In this video, I'm going to teach you how to use one of my favorite option trading strategies that can be used in any market.
Far too often, investors just pour their money into the market and hope it goes up. And that's often okay and wise for many people that may be investing a certain amount of money monthly and putting it into a retirement or another investment account. However, options can give us more options and allow us to grow our money in an actively traded account much faster than the S&P 500. I'm going to show you one of my favorite option strategies that can be used in almost any market and how to place an Iron Condor option trade, showing a real example on the option trading platform.
Hey guys, Darren here. Wow, do we have a great video for you today. First, before we get started, I'd like you to close all the other windows on your computer. All right, I'll wait. I want you to take a look at a strategy that not only limits your risk, but it allows you to make money no matter which way the stock price moves. Up, down, or sideways, you make money. I promise we're going to dig into many detailed option trading tips and tricks, so if you haven't subscribed already, please do so now. For me, it's super important that I'm using strategies that allow us to profit when the stock price moves in different directions. Be sure and download the free options workshop in the link below.
It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. What is one of my favorite option strategies that can be used to make a lot of money? Guys, we're talking about the Iron Condor option strategy. What is an Iron Condor?
It's a big superhero bird that flies down from the sky and helps people in trouble. No.
So let's start with a definition. An Iron Condor is an option trading strategy utilizing two vertical spreads, a put spread and a call spread with the same expiration and 4 different strikes.
You guys are excited now, right?
Options are used by big institutions, billionaire investors, and hedge funds. I think it's important that we understand all the different strategies and ways that the rich are getting richer, so that we can have the tools to do the same and do better for ourselves while doing it safely. Many people buy options, but as you know from previous videos, buying options is a low probability trade. It's much easier to profit by consistently selling options, and sometimes I like to be able to profit when the stock stays within a range, since we don't always know if the stock price is going to move up or down for sure.
So if we pick a strike above the current price and another one below the current price, and the stock price stays within that range, within the next time to expiration, the expiration date, then we keep all the premium collected up front when that trade is placed. An Iron Condor strategy is pretty much that simple. We want to be able to do it in any market and have a bag of tricks, arsenal, box of tools. We want to have different strategies available for us. Now be sure and watch to the end, because after you learn this simple strategy, I'm going to show you something that a lot of people don't think about, and it will allow you to add additional revenue or profit to your trades. So if you're ready, go ahead and hit that like button and let's begin.
How do we sell an Iron Condor? All right, for today's strategy, we're going to take a look at how to sell an Iron Condor and be able to profit whether the stock price stays where it is, moves up, or moves down. What is great about this strategy is that it utilizes less money and therefore it can be less risky.
It's actually defined risk, so you do know the max loss right up front. Now don't worry, we're going to go through everything in detail. You might be asking yourself, what are those two vertical spreads that make up the Iron Condor? Well, let's look at the first half of the trade. One wing, the put vertical spread.
Go to your Tastytrade account or whichever platform you are using. By the way, Tastytrade is one of the best and most intuitive for trading options. I'll put a link down below. Right now you can get up to $3,000 when you fund an account. Open up your app and let's go to a company we all know and love by punching in AMD on the Trade tab. We look at the option chains and click on the July 2023 chain since it's closest to 45 days to expiration. 45 days is the sweet spot since it allows you to collect a good amount of premium in a fairly short period of time while still allowing enough time to be right. Let's start by selling the put vertical first. We want to go to around the 25 or 30 delta. Delta is the column second from the right and measures how far out of the money we are. So it's basically a hedge ratio. You can see if we go further down to the 6 delta, we would only collect 55 cents or dollars since it's one option contract per 100 shares of stock. So it has much less chance of finishing in the money at the end of the 51 days to expiration. In fact, it would have a 1 minus 6 delta or a 94% chance of still being out of the money at expiration. The higher the probability of profit, the lesser amount of premium you collect. More risk and more premium. You get it. So we click the bid to sell the 110 strike and the ask to buy the 100 strike for downside protection. This makes this vertical spread $10 wide, and the 100 put serves as protection since we would be buying back the option if it dropped below that level. If the stock price did drop below the 100 level, the max loss would be the 110 minus 100, $10 width, minus $1.72 in premium collected. So $8.26, which is $826. The Tasty Trade platform also shows you this right on the platform in the lower right. This is the first vertical spread that we are selling. It's a credit spread, so we collect $1.72. One option contract, as you know, controls 100 shares, so that's $172 upon placing the put vertical spread. By clicking on curve mode, we can see that we collect max profit as long as the stock price stays above the 110. The 100 put option that we bought serves as the protection and caps the max loss should the stock price drop. You can see where the curve flattens off and is capped all the way down to 0.
I don't think AMD is going to go bankrupt anytime soon, but hey, if they do, you're protected.
The break even on this vertical spread is the 110 short strike minus $1.72 or 108.28. Since it's currently trading at 125.27, it would take a 13% down move before we lost a penny. So that's the first half of the Iron Condor. Now we'll do the same thing on the upside or the call side of the Iron Condor. We click on the bid to sell the 145 strike and the ask to buy the 155 call strike. We collect $145 for this side of the trade. By clicking on curve mode, we can see that we collect max profit as long as the stock price stays below the 145 strike price. The 155 call option that we bought serves as protection and caps the max loss should the stock price shoot up. The break even on the call vertical spread is the 145 short strike plus $1.46 in premium collected, so it's $146.46. Since it's currently at 125.27, it would take a 14% move up before we started to even lose a penny. This is the second half of the Iron Condor.
Now, we just demonstrated how to sell a put credit spread and a call credit spread in two separate trades. Wouldn't it be nice if we could do that all in one trade? Guess what? We can.
So we place the same verticals by doing exactly what we just did in placing the vertical spreads individually. We just do it all at one time. So we click on the bids to sell and the ask to buy the protections. Switching to curve mode, we can see the same profit zones on the downside and upside. With the stock price currently at 125.27, we have the same 13% downside break even and 14% flexibility to the upside. So that's a whopping 27% range that the stock can move around where it is today within the 51 days to expiration, and we still remain profitable.
The best thing is that since both vertical spreads are sold and not bought, it's a net credit when you place an Iron Condor option trade. So in this case, when all the trades are put on, we collect a $320 net credit since we're getting premium on both sides. And the other best thing I'd have to say is you can only lose on one side. The stock can't end up at the end at expiration on both sides. It's going to be on one, so one's an automatic winner. We ultimately hope that the stock price settles between the short strikes and we keep the entire premium that we collected up front when we placed the trade.
When placing an Iron Condor, we want to shoot for collecting about 1/3 the width of the strikes. So in this case, the width of the strikes is $10. The 155 long call, long being the call strike we are buying, is $10 away from the 145 short call strike. Short meaning we are selling it. 1/3 would be $3.33. We are collecting $320 or $320. You can move our verticals in closer and collect more in premium, or out further and collect less.
Now we mentioned a bonus. Here it is. Not every trade is going to go our way.
Hello darkness, my old friend.
Now there's one thing that we can do if the stock price does move against us. Would you like to collect more premium? Okay then.
We can manage our Iron Condor trade. So let's look at what are the possible outcomes of an Iron Condor option trade. Now, there are two things that can happen with the stock price. The stock can stay between our 110 short put strike and 145 short call strikes.
In this case, it's easy. We keep all of the $320 in option premium that we collected when we placed the trade.
Now, the second thing that can happen is that the stock price can drop below our 110 short strike price or rocket up past our 145 short call option and be in the money. The nice thing to know when this does happen is that we have on the long legs that we bought for protection to limit our losses. Whew. What I like to do though when the short strike is breached is close out and roll the winning side of the trade up closer to the losing side and collect more option premium. Say the stock price shot up past the 145 short call strike. What we can do is roll the 100, 110 vertical up to, say, the 125, 135 strikes. By doing this, we can collect more premium and move our max profit zone up, sometimes another $100 or even $200.
So we're actually moving with the trade. I love sports. I like to think of it as, in basketball terms, somebody guarding me on my left. They're on my shoulder, so I spin right, go to the hoop, slam dunk. Now,
depending on how far in the money the stock price goes, we can roll all the way up to the short strike of the winning side to collect additional premium. That would make it an iron fly, not an Iron Condor. We still want to keep our $10 width, and we don't want to go past the short strikes, as that would increase our risk and open us up to possibly being whipsawed if the stock moved up and then came back.
Which it will do, I know. All right, guys, if you're a beginner and this sounded a little bit confusing, don't worry. It did for me as well at first. We'll continue to cover option trading details and tips and tricks in future videos, and we'll learn together. I've put a link down below for the free options workshop. Be sure and grab that. Remember to hit like and subscribe. Let me know in the comments below what you're trading, what you'd like to see in future videos. Share this one with a friend, and I will see you in the next one.